Good morning, everybody. Welcome to episode 2 of our Plan B webinar series. Throughout this series, we'll be looking at the benefits that specialist finance can bring when your initial Plan A isn't available. And today we're focusing on a true Plan B option, bridging finance. Rarely will you have a client walk into your office and ask for a bridging loan, but you will see clients who face problems for which bridging can provide a great solution. Today, we'll be looking at current trends and market feedback while providing you with some hints and tips on how to first identify and then to maximize your completion rate on bridging finance. At the end of this session, you will have a better understanding of the bridging sector, when to turn to bridging, and know how it can help your clients, both mainstream and otherwise. For those of you that have joined us before, you will be familiar with the Q&A button at the bottom of your screen. But for those of you that are new, please take advantage of this during the session. We'll be taking live questions throughout the hour today, so please send us anything that's on your mind and we'll do our best to cover them off. As always, in order to help us understand this sector better, I'm joined today by two expert panelists. So please welcome Raphael Bengio, Head of Lending for Bridging Finance at MT Finance, and Ros Kaywood, Managing Director of Property Finance at StreamBank. Good morning, both.
Morning, Chris. Thank
Morning.
you for having us.
No problem. You're more than welcome. So Ros, starting with you, could you give us a quick introduction to yourself and your background in the industry, for those that may not know you?
Yeah, sure. Well, as you mentioned, I'm the MD of Property Lending at StreamBank, where I focus on building the bank and the lending side of the business, leading the sales team and driving all the strategic initiatives. So I don't have any responsibility for the savings side of the business. But going back, my journey in finance started way back in 1985. So I've got over 3 decades of experience working for lenders, a little bit of broking thrown in there as well. I'm fully CMAP qualified, and I've worked for a mixture of high street lenders as well as the first centralised lender and a variety of specialist lenders. I've been specialising in bridging and development now for about the last 10 years. And generally my roles have included sort of both underwriting, credit, sales, as well as business development and training as well. So I've seen many downturns and changes in the market, from the 1990s, where we saw negative equity rear its head and interest rates soaring to 16%, to the boom time in the 2000s, when we saw the creation of the packagers and the specialist distributors, and then the obviously eventual collapse of the market with the credit crunch, where we saw sort of lenders, products and firms literally disappear overnight. Luckily, we're in a more stable and resilient part of the market now, and I think it's just all credit to sort of how adaptive the industry is. So that's a little bit about me.
Excellent, thank you. Raphael, over to you.
Thank you, Chris. As you mentioned, I'm the head of lending at MT Finance for bridging. So I'm responsible of really all aspects of our bridging offering. So I'm involved, I sit with the new business team. So I'm very much involved with new inquiries that come across from a credit perspective. But also I'm there to support both the head of regulated and the head of unregulated underwriting. So I'm very much involved on the day-to-day on the underwriting side. And then again, I'm very much involved with our asset management and redemptions team on the back end. So I'm really involved and responsible sort of for the whole bridging loan journey, through from inquiry, through for completion, back to redemption. I've been in specialist lending now over 10 years, working for a variety of different lenders. That's always been sort of on the underwriting and credit risk side. I was an underwriter myself for many years and then went on to manage teams of underwriters. And now here I am looking after the bridging department as a whole at MT Finance and loving it.
Good to hear. And I've been at Crystal now for 17 years. Variety of roles from the underwriting side, the new business side, right the way through to my current role as ops director, basically looking after the day-to-day of the business and making sure that we can deliver that service that we so pride ourselves on. So we may not look it, but on the panel today, we've got over 60 years worth of specialist experience. So hopefully we can answer as many of the questions as you can fire at us this morning. So before we dive in, let's just cover off the very basics for those of you that might be new to bridging. So when we're talking about bridging today, we're talking basically about a short-term loan, typically for up to 12 months, but sometimes can be a touch longer, secured on property and with the plan to move from where we are today to a longer term solution. So the finance we're looking at is really bridging that gap between the two. So the key things that we're looking for in a bridge, other than obviously the basics, who it is, what the security is, etc., are firstly, why is a bridge needed? And secondly, what's the exit route? How will it be paid back? So if we can get those two things boxed off, they're the key really to the majority of bridging transactions. So covering off the basics then, jumping in to the content. Raf, do you want to start us off? How was 2023 for you and MT Finance?
I mean, overall, we had a very good year. We actually had our best year, record year for completions across regulated and unregulated, which was a fantastic achievement, something we're very proud of. However, I think that has to be taken into context, I think, of just the tricky macroeconomic year I think we all had, maybe as an industry in 2023, coming off the collapse of Liz Truss's budget in end of 2022, which I think we all sort of felt all of 2023. But that being said, I mean, that is completely outside of our control. Thankfully, none of us are responsible for that. So we can only look at ourselves and what we do best in context of all of that economic uncertainty. So having a record year in that was something we were very proud of. I think 2023, we took stock and invested internally quite a lot. We grew our underwriting teams further. We invested further sort of in our processes and our internal systems. And it's just, we sort of, I think, used that year while we still completed a record amount. It was more, let's take stock of where we got. Let's make sure that we can stay one step ahead of our service offering, and make sure that when we come out the woods, which I think we can all agree we're not there yet, but once we are sort of on plain sailing, we've got everything internally ready to sort of cash in and just crack on really full steam ahead. So it was an up and down tricky year, but again, the numbers show that we had quite a strong year on completion. So hopefully that sets us up for this year.
Roz?
Well, obviously, we're in a slightly different position in as much as last year was our first year of trading, having got our full banking permissions in February last year. So we were very much starting from a standing point. So we were always going to have a good year because we had nothing to beat. So we did have a great year. In terms of volumes, we doubled what we set out to do. So we hit our target in month 10 and we went into profitability just before the end of our first year trading, which I think is almost a record for a new bank. So we're incredibly proud of that. A game changer for us was introducing our regulated bridging product, which we introduced in September, and that gave us a really good flow of business and increased our completions by 50% from that period from September to the end of the year. So that was quite phenomenal. And all of that was sort of done within the background of sort of getting the team together, getting the right people in place, making sure that our service proposition was where it needed to be. You know, there's no denying that there were a few bumps along the way, you know, things that didn't go quite as planned, processes that we hadn't thought about, that we should have thought about, that we had to put in. But overall, a really successful year. And we've had some good learnings out of that we can sort of see us through sort of for this year and beyond.
Excellent. I think something that came across from both of you there was something that really underlines the specialist industry for me, and it's that ability to adapt, to maybe look at a situation and say, right, that might not be going where we want it to be. Let's do something different. And the speed of change and that adaptability is something that feels unique to this part of the market in particular.
Absolutely.
How has 2024 started for you then, Roz?
Well, obviously we're still a newcomer, so but we've seen a strong flow of business coming through, especially like I mentioned in the regulated space. There's definitely more competition, and we've seen lenders sort of tweak their rates. But the regulated bridging space especially is a smaller pond, so that has definitely been an advantage for us. And yeah, continuing to build the team. I've just finished recruiting for the sales team, so we've got all our BDMs in place now for the forthcoming year, which is good. And the underwriters, they're all in place. We put some additional resource in for that process between offer and completion as well, so we could focus on that. So we're quite optimistic about 2024. Yeah.
Yeah. Raf, how about yourself?
Yeah, I would say the same. I do agree with Roz. I think competition has kind of picked up slightly the first sort of part of this year, which truthfully is only a good thing. I think, I mean, it means that lenders have appetite to lend and everyone's trying to get a bit of market share, which again, I think is only a good thing for the industry as a whole. We had a strong Q1, which again was very good for us. We just come off a record month for new business coming in April. So I like to think cautiously confident for the year ahead. We're not fully gung-ho yet. We're sort of obviously keeping an eye on ourselves consistently, but I do think so far 2024 should be quite good for us, hopefully. Fingers crossed, touch wood.
Excellent. Anything you can share on your outlook for the rest of the year and beyond in bridging finance?
Yeah, well, I mean, go on. Sorry, Rose, you go. Go.
That's okay. I was just saying, well, we're further obviously looking to establish ourselves and build our brand. I think there's a lot of people that still don't know who StreamBank is. They either haven't heard of us, or if they have heard of us, perhaps don't know what we do. So building the brand is a big thing. On the other side of it, the general economic climate, obviously interest rates, property prices will significantly impact the bridging sector. And we'll need to look at how that continues to sort of play out for 2024. I mean, obviously you've got inflation has cooled, and there's lots of speculation about interest rates, whether they'll start to come down a little bit. So yeah, we'll have to see how it goes. I think we've still got an interesting year ahead of us.
Agreed. Raf?
Yeah, I mean, I just echo what Ros is saying. I think interest rate, obviously inflation has come down, which is obviously good news, but I think interest rates are sort of, and swap rates, which are equally as important, they're still sort of bumbling on around where they've been for a while. I think a lot of the industry is of the opinion that we should see some base rate decrease at some point this year. And I think the whole market's kind of waiting for that to happen as a bit of a stimulus to sort of kickstart a bit of growth. I think everyone's just waiting for that first Bank of England decrease, so everyone knows, okay, we're on the right track. Things are coming down to maybe where they should be. But I mean, with regards to bridging finance in 2024, I always think when the market's a bit of upheaval and there's a bit of tricky economic times, I think that's when bridging really comes into its own as a real tool, especially when maybe banks don't have those appetites that they used to have. I mean, mainstream long-term banks. And I think bridging can grow in popularity even more in these sort of uncertain times. I think it can be an amazing tool for clients that can get a bit stuck with interest rate rises and affordabilities. Sometimes a bridge can give them that 12 months breathing space. So I really think that even so far even if things get better, which hopefully they do from an economic point of view, still bridging has a massive part to play.
Yeah. And sticking with you then, are you seeing any particular trends in bridging applications coming your way?
I mean, again, not to hark on about the same point, but I think because of the economic times we're in, we've seen some kind of trends in the bridging of finance applications we're getting. For example, we see a lot of maybe long-term refinances that have come to the end of their mortgage term, and instead of going into a new refinance right now, a lot of people are of the opinion that in 12 months maybe, or in 9 months time, I might be able to get a better deal than I can get now. So I can bridge for 9 months, 12 months, buy myself a bit of time. Obviously interest is completely rolled up or retained, so there's no monthly payment they need to do. It gives them that sort of breathing space for 12 months, and then hopefully refinance out to another longer term lender for a better rate, hopefully in 9 to 12 months time. But on the flip side, we're also seeing an increase in refurbishment works, from heavy refurb as well as to light, but we're seeing a lot of conversions taking place. And I think, again, it comes on to sort of the interest rate environment we're in, but I think a lot of landlords and property investors are looking at the stock they have, thinking, how can I increase a rental yield on an investment property? How can I maybe split this property into an HMO or into a couple of flats to try and squeeze as much rental income out of a property as possible? So I think those are the two main trends that we've been seeing recently.
Okay. Thank you. Ross, how about you?
Yeah, it sounds like we've conferred really before the start of this, but we're seeing similar trends. I mean, we're seeing a lot more chain breaks, and that's coming down to people, the market again, properties taking longer to sell than expected, or maybe people just trying to hold out for what they think the property's worth. And it has been a tricky market for sales. We're seeing a lot of refurb as well. And again, I was going to make the point that you see a lot of people perhaps going down the conversions into HMOs for better yields than perhaps a traditional sort of buy-to-let. And the other thing we're seeing a lot of, again, is rebridges. I think exits just generally are harder, whether it's people, having slower sales or just, thinking I'll hold out, like Raf has just mentioned about interest rates, where they're going to be on the mortgage, thinking, well, if I stay on the bridge a little bit longer, then hopefully rates will have come down and then I can refinance when the rates are a bit lower. And then also the other thing is that sometimes building works are taking longer than anticipated. So while building costs have stabilised, which is good, things are still taking a bit longer, meaning that they're perhaps going over the end of the term. So yeah, chain breaks, refurb and rebridges is what we're seeing a lot of.
So yeah, very similar trends there. And similar to what we're seeing as well. I think the market, certainly on regulated bridging, as we touched on earlier, there's some very good products in that space now. It's a viable option for customers rather than it being a product of last resort. And both of you there are talking about the customers almost taking bridging by choice rather than it being the only option open to them, which is quite an interesting take on things. And again, the ability for a customer to buy time is something that's overlooked quite a lot. I think people look at bridging and, you might look at an interest rate of 0.8, 0.9, 1% and think that's quite expensive. But actually, it's the time you're buying to get you from A to B. And that could be to do a refurb or it could be to access better products. It's an interesting sector. So we're seeing quite an increasing number of inquiries for rebridging at the moment, maybe deals that were taken out 12, 18 months ago that are coming back to market, and instead of taking the preferred exit route, they're looking to buy an additional chunk of time in order to get to that period where they want to get to. So Ros, what are you seeing on rebridging and where is the appetite at StreamBank?
So I think a lot of the rebridges that we're seeing is probably, well, twofold really. Either the sale hasn't happened or the sale has fallen through and they need more time to sell the property. Or they're doing maybe they're doing refurbs and works and they haven't quite finished the property, so they either want to raise more money and more time, or just more time to sort of finish off the refurb. Those are the two main things. I mean, we're okay with rebridging. We'll go up to 70% loan to value on a rebridge. We don't like third and fourth time bridges. So, if we've got serial rebridges, then we would sort of ask questions, why is perhaps the exit not working out? Because that's the one thing in bridging, we've always got to make sure that the exit is viable at the outset. So we do have to look at how they're going to exit, make sure it's viable, make sure it's achievable. So that's the main thing. But generally on rebridging, we're okay with it.
Raf, how about you?
Yeah, same. MT Finance, we do have an appetite for rebridging. I say this about every case, but we pride ourselves on assessing each case on its own merits. And it's the same very much for rebridging. However, when it comes to rebridging, I think we look at it that little bit closely. The reason being, I think it's extremely important when assessing a rebridge that we look at the original loan quite in depth. What was the original loan taken out for? What was the original exit route? Why has that not taken place? Why is the client now confident they are going to be able to exit within this new loan term? And also, are we confident the client is going to say what is going to do what he says he's going to do within this new loan term, seeing as he hasn't done it once before? So all of those questions come into mind when you're assessing a rebridge. However, we definitely do have appetite. We do it relatively regularly. However, we look at them quite closely, I would say. Now, Ros mentioned a good point. There is a lot of economic factors, which means that clients haven't been able to get out of loans as quickly as they wanted to. 12 months isn't a long time if you need to do work. So you need to sell a property, which might not be on the cleanest roads where demand is always high. There might be works taking place and they might be let down by builders. So vast majority of the time, there is genuine reasons behind it. You just, I think as a lender, you need to look at that closely and make sure that your loan can get out in time and that we're giving the client enough time to complete the works, get it done, or if they are selling a property, making sure that it's being marketed at a reasonable asking price and the client themselves are not being too opportunistic with the asking price or something along those lines. So we just look at them quite closely, I would say.
Excellent. And that ties in with consumer duty as well. Obviously,
exactly.
The onus being on all of us really to reduce foreseeable harm to customers.
For sure.
So it's not just a case of putting them in a bridge. How do we get them out? And that, you know, rebridging might be the right option for them because refurb might not be done or the sale's delayed. But also a term loan might be the better option to take them out, or even a sale. So it gives a great opportunity for advisors to really take the customer through that journey. Because for every bridge, there's always an exit that needs to be arranged as well.
Absolutely.
We've had a couple of questions come in live, so I'll pick on a couple of those whilst we're here. So Nigel's asked, do either of you offer second charge bridging? Raf?
Yeah, we definitely do offer second charge bridging. We do second charge regulated, we do second charge unregulated. We usually go up to 65% loan to value on a second charge. However, we definitely do second charge for all types of reasons. Again, the exit route's very similar. We look at that quite in depth. However, yeah, we definitely do offer second charges. Absolutely.
Thank you. Ross?
So we don't at the moment. We can do a second charge as a cross charge. So again, on a typical chain break, then they're usually doing a first charge on the purchase property, and quite often they want to do a second charge on their existing resi or another property. So as a cross charge, it's fine, but not standalone seconds at the moment.
Thank you. And that's a great option for that chain break, isn't it? Instead of just securing on the onward purchase, you can unlock some of that equity that's tied up in the home that they're looking to sell on.
Yeah, and also on other situations, you can use an additional security to get up to 100% borrowing as well. So that's another option.
Excellent. We had a question from Tom, new to bridging. Is interest paid monthly on the length of the loan, or is it all paid back when the loan is refinanced at the end? But typically with bridging, it's all paid back at the end. It's rolled up within the loan. There are a couple of lenders that offer a serviced option if it's non-regulated. But again, we've got to look at the affordability of that. You know, is it the right option for the client to be paying 1% a month on there when it can all be rolled in? Most customers take it rolled up just due to the ease, and I suppose the way the loan's structured seems to work better for them that way. Anything to add to that, anyone?
Yeah, I mean, the people that want to do serviced are generally where they've probably got an income producing asset. So they'll perhaps go down the serviced option, but otherwise most people, like you said, just pay it all back at the end.
Yeah, I couldn't agree more. We see the same on our side. We do offer serviced on unregulated if the client can prove affordability, but the vast majority take rolled up. I think it's just easier for the client that they get one redemption figure at the end and know exactly how much they need to repay.
Excellent. Thank you. A couple more questions in. Thank you for the questions. Please keep them coming in. It certainly helps us with the content if we know what it is you guys want to know as we're going through these. A question from Dumming. What is the, when you take a bridging loan, is it based on the property or the borrower? I think it's a bit of both, isn't it? Raf, while you're on screen, do you want to take that one?
Yeah, it's definitely a bit of both. I mean, at MT Finance, we pride ourselves on always being sort of an asset-based lending approach. So for us, the security and the property we're taking as security is of paramount importance. What are we lending on? What kind of property is it? Commercial, residential, semi-commercial? What state is it in? That is of extreme importance because essentially, worst case scenario, that is our security for the loan. So we look at that very, very carefully. However, I'm not saying by any means that we ignore the profile of the client. We obviously take that fully into account, who the client is, sometimes looking at his credit, depending on the case. However, so we definitely look into both, but we are very much an asset-based lender. So the security we are lending on is of paramount importance to us on any application that we agree.
Thank you. Ross?
Yeah, very similar in as much as it's the property and it's the exit, but we do look at the client. And the reasons we look at the client as well is sometimes when we're looking to do exceptions and be flexible, sometimes the profile of the client will make the difference. So you know, we have done some deals where we've perhaps focused more on the client than the actual security because of the client and what they've done and their profile. So it can be equally as important, especially if you're looking for some flexibility and yeah, to do perhaps something outside the box.
Thank you. I think the other way the client would come into it is probably around the exit route, because although
Yeah, agreed.
the client themselves could have various different criteria and there could be other things in the background, can they get out? If we've got a client with 9 months worth of mortgage arrears, for example, and the exit's going to be refinanced, that might raise some questions from an underwriting viewpoint.
Absolutely.
Yeah, definitely.
Excellent. Hopefully that covers the question. Thank you. Annabelle's just raised a question which leads us nicely into my next question here. So Ros, what are you seeing currently holding up applications? Exit route, valuations, what tends to be the stalling point at the moment?
Well, we're not seeing too much of a trend of that at the moment. Valuation times are going out a little bit. We are seeing that. But we've got comfortable with AVMs and desktops as well. So we've got perhaps another solution for that as well, and it gives us options. I think it's all about just being in constant dialogue with the brokers and with us. You know, good communication is key. Sometimes people aren't talking to lawyers, or if an offer's been issued and, you know, for example, undertaking hasn't been paid, so the solicitor's work hasn't been done. Sometimes they're all things that can sort of help. So I think it's all about good communication, really.
Yeah, agreed. Raf, how about yourself?
Yeah, I mean, I agree with Ros saying I have personally seen myself, excuse me, I've personally seen valuation times taking slightly longer than I would like. We always want a valuation back the very next day, but that's always not always the case. However, similarly, we also do offer AVMs up to certain criteria, so that is also another option. I mean, my biggest frustration on any application is 9 times out of 10 the legals and the times that sometimes it takes for solicitors to get through the required work that needs to be done. And I find that that's usually because sometimes client solicitors aren't necessarily used to bridging work, or maybe the speed that bridging work wants to move at. I'm not talking for other legal departments or legal work, but sometimes you can have legal work sitting there for a couple of days and it's not of absolute urgency, whereas my team are very much trained to chase solicitors if we don't have movement in 24 to 48 hours. We want to see consistent moving on an application, and I'm sure the client wants that too because they can get their money. So I always tell brokers when advising a client on which professionals they use, make sure they use a solicitor that they've used, that they know does bridging work, or have worked on bridging finance before. So at least they'll know what kind of inquiries they're going to get. They'll know the speed that everyone wants to be working at. And that usually kind of helps to sort of get that case over the line as quickly as possible. But that's why I think my usual bugbears are valuers and solicitors.
Yeah, that's good advice. Yeah.
Yeah, and I know from working with both of you that both lenders can complete bridging really quickly, can issue documents really quickly and get things moving. A lot of the time the holdup is third-party providers, be it valuers, be it solicitors. Sometimes it's even just getting an appointment with certain valuers in certain areas can take longer than expected. So when you see the headlines that bridging can complete within hours, within days, it can. You know, we've completed 8 bridging loans this year so far in less than 3 days. So they can go through, it can happen, but you're very reliant there on a good solicitor, a good valuer, and a good client as well, because you know, when we're asking for information, we need that information to come in quickly, completely, to give the underwriter the right picture of what they're looking at. So the delays a lot of the time tend to be other parties. But again, you know, with a good broker involved, a good advisor involved, you can get ahead of all that, and we can have those conversations, as Raf said. You know, make sure you're choosing the right solicitor, make sure you're getting the right documentation back at the right points, and that could really make a big difference with the application. And just for clarity, we've had a question come in on AVMs. An AVM is a desktop valuation. So rather than a valuer having to physically go out to a property, lenders can now use a desktop, basically a computer-generated model that will give them a valuation of that property that can be used. So hopefully that covers that one off for you. Just following up on Annabelle's question, valuations coming in lower and managing client expectations is something that she's seeing a lot more of at the moment. Roswell, you're on my screen currently. Do you want to take that one first? Are you seeing much of that taking place?
Yes. Yeah, and I suppose some of it is down to like how much research you do into, certainly on a refinance. You know, how much research is done into where you realistically think the property is going to be. I mean, obviously on a purchase or an auction purchase, then you're pretty sort of, you know, quite sure that the valuation is probably going to match what the purchase price is or the auction property is being sold for. But on a refinance, you know, sometimes people can overestimate what they think the value of their property is. All the current market conditions, we did see a real slump of property prices towards the end of last year. And I think there's an expectation from some clients that their properties were still perhaps worth what they were at maybe the beginning of 2023. So the market has changed. I mean, the good news is that, you know, Savills report that it's starting to improve. So that's good. But I think when it's clients' expectations, and of course, you know, there's the old adage, isn't there, that, you know, my house is nicer than the one next door because, you know, I've got stone cladding and they haven't. So, yeah, we do see it. But we work on open market valuation, which helps as well. But yeah, I think it will always be a thing despite what the market is seeing. I think, yeah, a lot of times, you know, if you go to an estate agent, they might just say, well, we can put it on the market for X, you know, so we have a marketing price, and then maybe people don't think, well, if that's a marketing price, not perhaps, you know, what a property is going to go for, you know, when the valuer goes out and he's actually comparing it with actual sold prices in the area.
Raf, anything to add to that?
Yeah, I mean, again, I couldn't agree more. I think we've definitely been seeing some down valuations, and I think thinking about it, they've been more so on the regulated side, which I think ties into what with Rob was saying. I think people have personal attachments to their own main residences, their own properties, and sometimes think they're worth more than they actually are, which is perfectly understandable. However, when it comes time to get a real valuation, sometimes they can be shocked at what it actually comes in at. So I think what we actually try and do is, especially on a regulated case, where before we even instruct a valuation, if we are max loan to value, so we know that a down valuation is going to affect the amount a client can borrow, we try and do a sense check internally before we instruct valuation, doing a bit of research to see whether we think the client's estimate should stack up or not. Obviously, we're not valuers, but it's more of a sense check that if we feel they are way off, that we might immediately inform the broker to say, there is a chance this could come in down value just by sense checking the market and some sold comparables online. Obviously, we're not valuers and they may come in on value. We'd rather manage expectations on day one to say there is a chance this might come in down value. Does the client have a backup plan if there's a shortfall, X, Y, Z? Funnily enough, or less so on the unregulated side. It could be maybe because we're dealing sometimes with experienced landlord and portfolio clients who understand the real estate market, understand that in 2023 there was a bit of a cool off, so sometimes they're a bit more realistic with property values. However, we also lend on open market value, which helps. And yeah, so I think it's just the nature of the beast. We're always going to see down valuations. I think it's how we manage them and manage brokers and introducers' expectations for their clients.
Yeah, both very good points there. I think some trends that we saw certainly at the back end of last year was people taking the very best property within an area and comparing their property to it rather than necessarily a realistic view of where they were. Yeah. Particularly, we had a new build block of apartments, 6 apartments, then on the south coast, and it was a first time developer, and they compared the GDV of their apartments to high spec, top of the range, overlooking the coast, you know, really nice high end apartments. Theirs were a former shop conversion that were overlooking the train station. No. Well, those went for this, so mine should go for similar. There's a bit of realism there that's needed, but also there's the delay on valuations that we keep seeing. You know, if it takes longer for a property to go through the sale process, valuers are using sold comparable evidence. Yeah. So therefore, it's not going to be an instant change if the market's, you know, properties are listed today for for 500,000, it's going to take a while for that to go through to uplift that comparable price.
Very true.
So I think there's a bit of both there. We've got a couple of technical questions that have come through. Is there a minimum term that you take a bridge out for? Either of you got minimum terms?
Yeah, I'll go on that one. It differs between regulated and unregulated for us. And I think it comes down to the exit, especially on regulated being such a focus of the underwrite on our side. So I think it depends. Truthfully, I would say it's usually 9 months. We offer a maximum of 12 months, obviously, on regulated. I would say usually our minimum is between 6 and 9. Only because we try and be more cautious and give the client as much time as possible to exit the loan. Now, there are times where it's a very clean chain break purchase. The client's selling their old main residence, buying a new one. They haven't managed to sell it in time. And sometimes maybe they're getting a refinance on the new purchase and they've got an illustration on hand already, and that application's already progressing. So we know, all being well, the exit should come through in a couple of months. However, I always like to sort of err on the side of caution and give the client an extra couple of months, because we all know there can be delays with things going on. So I'd rather always give them extra time so that they can exit within the term of the loan. Similarly, on unregulated, however, we can be a bit more flexible on unregulated because we can offer longer terms. So we can offer up to 24 months on unregulated. So yeah, I mean, it's hard to say. We look at each case on its own merits and what's the exit, what's the funds being used for, and all that. So I wouldn't say that we have a strict minimum.
Okay, thank you. Ross?
Yeah, there's not a lot to add to that. We have a very similar approach. I think if people are asking for sort of 6-month terms at the moment, then you would look closely about whether, what they're intending to do, where they are. I mean, it's fine if all the legals have been done and they're very close to completion and they need a very quick bridge. But usually at the moment, we're finding with sort of exits taking a bit longer and being a bit trickier, we'd always err on the side of trying to give them as long a term as we can, to make sure what they want to achieve and the exit can all be realised within the term. Yeah, which is obviously 12 months. You're limited to a maximum 12 months on a non-bridge. I'll start again. You're limited to 12 months on a regulated bridge, but you can go up to 24 months on a non-reg one.
I think the important thing to take away from that as well is that most lenders don't charge early redemption charges or anything like that, subject to a minimum 1 or 3 months interest normally. So if you do take a 12-month bridge and you exit on month 6, that's fine. The client doesn't pay the additional interest there. But if you take a bridge for 3 months and you need it extended, there could be additional charges, revaluations, other things that need to be done there. So again, something we touched on at the start, preventing foreseeable harm. Let's make sure that the product that we're selecting for the client is the right one, and that includes the length of the term there as well. Maximum age. Ross, do you want to take that one first?
So we can go up to aged 85, but again, talking about consumer duty and vulnerable clients, we do have to make sure it's the right thing for the client. So where we are dealing with older applicants, we probably do have to look a bit more closely as to what they're doing, why they're doing it, and if it is the right solution for them.
Excellent. Thank you. Raf?
Yeah, similar. We also go up to 85. We have done a couple above 85, sometimes where there's a power of attorney in place and maybe the child is also going to be on the loan. And again, the deal makes sense in terms of the power of attorney, who's benefiting from the loan, the exit. The loan has to make complete sense. For example, it being care home fees for the parent or something along those lines. But yeah, our usual maximum is 85. Again, we look at each case and make sure they make actual sense for the client at that age and that the loan really benefits them and the bridge is the right thing for them. But that's where our quality introducer comes in.
Excellent. Thank you. We have got lenders that can go a little bit beyond that. But again, as the guys have said, it really comes down to that suitability. What's the exit route? If it's remortgage and the client's 92, then we need to see a viable exit for that it is possible to get them out. If it's sale or it's care home fees or anything like that, then there's a bit more chance of that going through. rebridging question that's just coming from Nigel. Are the rates and fees the same as the initial bridge deal? I think the difference with rebridging here is that we're moving the bridge from one lender to another one. So we're doing it, it's a brand new transaction. So I think with both of you, it's just treated as a standard deal, isn't it? There's no additional fees or charges from a rebridge.
Yeah, that's exactly right. Yeah.
Excellent.
Exactly.
Jumping back to the pre-listed questions. Thank you for all the questions coming in. It's really useful to us to see these coming through. Really helpful. So recent data from the OECD highlights that the housing supply problem in the UK currently. The UK disappointingly topping the table of developed countries. 43 people homeless from every 10,000 in the population was the data that come through. Are you seeing anything from landlord clients to address that? Ros, do you want to take that one first? Have you seen the creation of new dwellings?
I think there's no doubt
refurbs?
Yeah, I mean, I think there's no doubt, like you said, that the private rental market is in short supply, but the demand is sort of outstripping it at the moment. I think, professional landlords move with the market. They know what they're doing. I think refurbishments are a much higher standard than they've been in the past. There's obviously been a focus on EPC ratings, which has driven this to some extent. And obviously, legislation is changing next year. So we're seeing more of that where people, landlords are improving properties to get the EPC ratings to sort of where they need to do. Many landlords are obviously making their rentals available for social housing associations. I mean, it's almost a win-win for them as well, in as much as they get a guaranteed rental, so they avoid rental voids, and they can get it guaranteed for a period of time. We're seeing lots of developers using the change of use rules, so maybe taking sort of commercial buildings and converting them into residential, into sort of blocks of flats or multi-units available for renting. So there's a lot of activity, and I think it all comes down to the landlords moving with the times, knowing the market. And again, HMOs we touched on before, that's another way that they're doing that, to provide, it gives them a better yield potentially, and obviously it provides a sort of another option sort of for the rental market. So yeah, there's generally, a lot of activity. Certainly hasn't slowed down.
Great, thank you. Raf, how about you?
Yeah, I mean, echoing a lot of what Ros has said, I think we see a lot of landlords doing more HMOs than ever. I think HMOs are more popular than ever with regards to, one, from the HMO side, creating more of a rental yield from a property, but also they get to house more people, which I guess helps the problem to a certain extent. Conversions under permitted development, we're seeing more than ever again, which I think was a great scheme. The fact that I think with little or minimum planning, really, you're able to convert commercial buildings and sometimes even agricultural buildings to residential. I think I agree totally with Rosa, but I think landlords are really doing all they can really to sort of assess, sort of address this problem. On the flip side, I don't think it's necessarily their problem to address when you look at the fact that this country has had a housing supply problem for quite so many years, and nothing really has been done by the government, I think, of any substance to kind of address it. So I think more definitely needs to be done with regards to, maybe a bit radical, but looking at the planning sort of department as a whole. The whole planning process is so arduous and takes so long. I think there is definitely something that can be streamlined there to sort of make getting planning easier, to sort of invigorate people building houses, whether it's the taxation in property that sometimes puts people off, whether it's, the buy-to-let laws changed not so long ago, which caused had a ripple effect on people being landlords and properties being created. So I think there's a lot to do for us to sort of address this housing problem. I think landlords are doing really all they can with regards to trying to create multi-let properties and converting where they can, but I think we need more from our government with regards to the housing supply problem in this country.
So there's some valid points in there. I think there's been mixed messages, hasn't there, with again, as you mentioned, EPC ratings. We're encouraging landlords to spend more on property to increase the standards. when actually it's the supply that's part of the issue.
Yeah.
So we need more properties available for people rather than necessarily heat pumps and things like that installed within them.
Exactly.
Yeah.
So we've had quite a few questions just come flooding in. So again, thank you for all of those. Looking at so when we've talked so far about a bridge and the exit and getting that right, when it goes wrong, we've had a question come through about how quickly do you proceed to repossession, or do you try, excuse me, to find a solution to exit the loan? Raf, do you want to take that one first?
I mean, we never want to repossess a property. Ultimately, that's always our bottom line. Unfortunately, we're a lender, and there are sometimes that we have to. However, we really don't like doing it. We'd much rather the client exit us by any other means, whether it's a refinance or a sell. So we really work. And again, this is where an introducer becomes worth their weight in gold. I think having a quality introducer on your back as a client means so much, especially when things go wrong. And obviously clients can speak to lenders direct once the loan is live. However, going through an introducer that probably has a relationship with the lender, I'm sure there is always times that we can find ways around it, whether it's an extension, whether it's a period of grace or something along those lines. We always try and find a way around a problem, around a hiccup, around an obstacle that's come up with the client's exit, grant them an extension, speak to the advisor. I think it comes down to what we were saying before about communication between the client, the introducer, the lender. That becomes ever more important when things go wrong, or when maybe the term of a loan is edging closer and closer. But we will always try and work with the introducers quite closely to find a way around it rather than repossess. So that is always the last resort.
Ros, as a newer lender, it's probably something that you haven't yet had to come across as much.
Well, yeah, we have. Not necessarily go down the repossession route, but it's all about communication, isn't it? So, we have got people coming to the end of term, and if they've needed further advances, so they might have run out of money, so they want more money to finish off the works, or if they need more time to get the exit to do, then again, we'll always find a way to do it as long as they're in communication with us and they're upfront about what they're doing. So, for example, there'll be some post-completion conditions. If that's like the property has to be marketed within 3 months, if you're getting close to the end of the term and they haven't put it on the market, then perhaps that's a different conversation. Or if you're trying to get hold of clients and you can't get hold of them, they won't talk to you, that is not a good situation. It's much better to be open and transparent about what we can do, because we can do further advances, we can extend terms. And also what we've started to do in 1 or 2 cases is actually offer where they are looking as a buy-to-let refinance and they might be having trouble with that, then we have extended and put them onto a sort of longer term buy-to-let product as well. So we've sort of started to do that for some clients as well. So there's always a solution as long as you communicate well.
Definitely, that is key. It always surprises me when we get calls a week before the end of a term from a broker or a client saying, I've got this bridge with XYZ, it's coming up to the end of its term, I've got a week to renew, what can we do? Or stay close to the transaction.
Not uncommon at all.
Yeah, and we see it on the other side when people are rebridging, and it's like, can you do a rebridge? And then they say, it needs to go through like in the next week or so because they're about to be repossessed, and you sort of think, well, actually, it's a nice little deal. Why didn't they do something a bit sooner? Yeah.
And it's staying close to the customer, isn't it? Staying close to that transaction, making sure that, if it is on the market, how's this marketing going? Have you had viewings? If there's a refurb taking place, how is that going? Is it going to schedule? Is the work on track? And these are good opportunities for a broker to retouch base with the client. Is there anything else I can help you with? How can we fix this problem?
For sure.
Sticking with speed, we had a question come through. Auctions have strict deadlines of 28 days. Is there anything bridging does to avoid some of the hurdles, valuations, solicitors, etc.? I think we've touched on desktop valuations and AVMs that you're both looking at. Solicitors are key in that transaction, and I know with both of you can get documents out, you can get offers, solicitors instructed really quickly on deals. Again, for me, a lot of it comes down to just owning that deadline. If there is a deadline, let's make sure everyone's aware of it, everyone knows what's happening, what we're working to, and that all parties are pulling in the same direction. We don't want people waiting for a week to send documents back or paying an undertaking when we've got a very strict deadline to get that through.
Yeah, I mean, when you've got a motivated client and they know they've got a deadline looming, I feel that helps the transaction a lot because they're going to be motivated with their solicitor, with anyone to push that from their side, which it becomes extremely important. I mean, there's no reason that bridging loan should not be completing in 28 days. Even if you need a full valuation, there should be no reason whatsoever why that cannot happen in 28 days, even if you need full legals. I mean, with auction purchase, a lot of the time when it's a strict auction purchase, we can look at indemnity sometimes on the legals to make that quicker. An AVM is an instantaneous valuation. So there are many sort of tools that we can use. However, if you've got the right people backing you, right introducer, right solicitor, there should be no reason why you cannot get that done in 28 days. That's for sure.
Yeah, the only thing I would add to that is dual representation as well. That can sometimes make it a bit smoother as well, given that then you've only got one set of solicitors dealing with a transaction rather than sort of bouncing backwards and forwards between two different ones. So yeah, that definitely helps with the speed.
Excellent, thank you. We're running a little bit short on time, so I'm covering off some of the questions through the chat facility. So certainly thank you for those. Please keep them coming through. Ros, while I've got you on screen, can you give us a quick case study which you feel highlights your product and service offering there at StreamBank?
Well, when I asked the underwriters for some case studies, they gave me all they're either large loans or really, really complicated. And I thought sometimes, you know, it's all about just some sort of bread and butter. So, you know, very quickly, a rebridge for 300,000, 70% loan to value, just needed to rebridge as they had a sale, but it had recently fallen through. It was a first and second charge, so a cross charge across two properties. We did an AVM on both properties, and it completed within sort of 19 days. So that's just a sort of bread and butter quick one. And then just another one where there was a client, a UK national based in Dubai, so he's an expat. He was purchasing a residential home for him to live in the UK. Exit was refinance. It came in and completed within 5 weeks. There were some rental charge issues at the legal stage that we had to overcome. But yeah, just, you know, I suppose with that one, it just highlights the fact that even when you think you've got a pretty straightforward case, you've got an expat, so his income wasn't necessarily UK based. You had to check out the exit, there was going to be a lender that would be happy with that situation. And then just when you thought it was all going swimmingly, you get some issues with the property that he's purchasing with rental charge issues, and that's quite often what sort of scuppers it at the end, doesn't it, where something comes up that's totally unknown to anybody. So yeah, that's just some simple ones.
Thank you. Raf, how about yourself?
Just one that came to mind when I was looking up, which I think is quite pertinent for the market that we've been in a lot, and essentially how a bridging loan can sort of help landlords and property investors increase their rental yield. So we had two siblings who inherited a 3-bedroom property around 14 years ago. Since then, they've essentially not been doing much with it. They were letting it out as one property, 3-bedroom house, getting the rental income. However, I think they probably had a good advisor on their hand who told them they could be making a lot more from a rental income point of view on this property. So they decided to do some work. They got planning, decided to do works to convert it into into 2 flats to increase the rental income. As always, they started the works, didn't actually get very far, and realized they didn't have enough money to complete it, which I think we do see a lot. So the clients came to us for a bridge. We completed it from an application to completion in around 3.5 weeks. We gave them £130,000 to complete to sort of pay some builders' invoices and complete the works. We obviously had a valuation done. The valuer looked at what the property was going to be worth as 2 flats, the rental income. So we immediately could see what we could do our sense check. We could see what they could achieve from a buy-to-let refinance based on that income. And yeah, they gave them a 12-month term to complete the works, and they went ahead, buy-to-let refinance both flats. So again, very simple, straightforward, but it just shows how a bridging loan sometimes can be. I know this is all about plan B, but that sometimes bridge can be the plan A. Really use a bridging loan, use the short-term money, do works which you know that should be completed within the time frame. you know what your rental income is going to be. You can buy to refinance it out, long-term income. And that, I think, just shows how bridging can really be used to sort of extract that bit more from your existing portfolio.
Excellent, thank you. A question that I always like to drop into these, if you could make one change to the property market, what would it be and why? Raf, we've got you on screen at the moment. I know you've mentioned the planning rules earlier. Anything else you'd like to add to that?
I mean, for me, planning is a big one. I was in development finance many years ago, and I could see sort of the smaller house builders, not your massive multinational house builders, but your smaller house builders who don't have sort of the funds to sort of land bank sites, but sort of move from site to site. And sometimes they've got amazing sites which are ripe for redevelopment, but sometimes one council will get them planning in a matter of 6 weeks, and then another council, it could be 6 months. So having some sort of baseline across the country on what exactly people are expecting when it comes to planning, or even streamlining the rules, maybe using technology to sort of streamline planning applications, planning appeals, I think will have a massive effect on rebuilding the UK and rebuilding more houses and getting planning approved for new developments, social housing, as well as affordable living. A lot of sky-rise blocks coming up with £1 million penthouses, which obviously vast majority of the country can't afford. So I think it's all about, I think, looking at the planning, looking at affordable housing, real affordable housing for real people. That is where I would make a change, because I think could have such a benefit for so many people.
Ross?
So I'd like to see more flexibility on the term of a regulated bridge. So as I mentioned before, when I eventually got it out, a regulated bridge is limited to 12 months. And I think there's so many examples where that doesn't necessarily work for the client. So for example, if somebody's doing a large extension or take a ground up regulated development, you're limited to 12 months. So your planning has to be in place. If you haven't, if you're doing a purchase and you haven't got the planning, you've got to get the planning in place. You've got to actually do the build, and then you've actually got to exit the bridge within 12 months, which is nigh on impossible at the moment.
Yeah.
So, I'd like to see there perhaps a little bit more wiggle room, that there's examples where, say, 18 months would be just much more feasible and allow people to do what they need to do. So that would be mine. Yeah,
I mean, I'm just going to jump on that. I literally couldn't agree more. It seems quite inhibitive having a 12-month limit on regulated loans. 18 months, I think, would open up the regulated bridging market to a whole host of other people. You'd get regulated self-builds and stuff like that. I think that's a brilliant one. I couldn't agree more.
I think 12 months was probably ample a couple of years ago when things were going through quickly and there wasn't the delays that we now see, whereas we're seeing average bridging loans now 60 days to complete, just for kind of typical straightforward things. You take a mainstream mortgage, how many brokers on here can get a standard residential mortgage through in a month, 6 weeks, 8 weeks? It doesn't exist anymore. You don't need that 3, 4, 5 month window to get that done. Had a bit of refurb at the start, a delay with materials. I'm looking at having some work done to my house at the moment, and we've got builders quoting 6, 7, 8 month lead times before they can come out. So I'm glad I haven't got a bridge on that currently. But no, two really valid points in that. Thank you. So Ross, do you think bridging is still a good option for brokers in 2024?
Do you really want me to answer that one? Of course. Like you started off by saying, bridging's always a solution to the end game. It's not the first thing that a client would typically sort of phone their broker up and say, I need a bridge. It's always, I want to buy a property, but it's uninhabitable, or, it's an auction purchase, or I want to do some works. So it's always a solution to an end. And there's so many reasons why you can use bridging. I think historically it was almost like the dark side of lending, and if anybody mentioned a bridge, it was always like, oh, that's too expensive, or don't need it. But when it's understood what a bridge is and how it can be used, and when you look at the costs, it's a completely different structure than it would have been sort of 5-10 years ago, etc. And I think it's definitely something that all brokers should have in their toolbox. And like you've alluded to before, it helps them, it helps the clients on their journey. So they might want to purchase a property, they might want to do it up, then they might need to refinance. But yeah, of course, bridging's definitely got a place.
Thank you. Ralph?
Yeah, I couldn't agree more. I mean, over the last 10 years or so, you've seen bridging sort of grow in popularity year on year, be it a good economic climate, being a bad economic climate, there's always had a chance to play. I think it's actually quite resilient to sort of the macroeconomic conditions. I think it always has a part to play and there's always a use. The flexibility naturally of the product is something that like Ross said, all brokers should have in their tool sheds in order to sort of advise their clients. I think these webinars are extremely important to sort of educate the wider sort of introducer community who might not be used to bridging, who might think it's only for chain breaks. They might not think that, oh, I can pay a tax bill with a bridging loan, or I could do an extension of my house with a bridging loan that sometimes might actually be the best option for the client. So I think the education, we all have a part to play in that. But bridging, I think, is only going to get more and more popular and will get as streamlined as a residential mortgage, I think, given how useful it can be to clients and everyone.
Thank you. Just picking up on the point you made there, was about people viewing bridging as expensive. I actually was having a look at the Bridging Trends data that MT kindly provided earlier. Back in 2021, base rate was 0.1%. The average back in 2021, bridging was 0.1. 2023, it went up to 5.25, so a 4.25% increase almost over that period. The average bridging rate has only increased 1.3% per year over that period. So comparatively, bridging now is cheaper than it's probably ever been in comparison to more mainstream financing. So it does have this view from a lot of people that it is a dark art, it's an expensive product, it's something that you should look at as a last resort. But really now it's probably the best time to take bridging, assuming you can get the exits from a financial point of view than it's been. So the other key thing I want to pick up on from this is the benefits of using a good team, good valuer, good solicitors, good lenders, as we've got on the panel today, but also using a good broker, a good packager like Crystal. So even if you're not experienced using bridging finance, we've got a referral option where you can give us the client's name and number and we'll take over the transaction for you, still paying you 50% of the prop fee that comes through. And we charge no fees on all bridging business that we complete. If you do want to be involved and walk your client through it, you can use our packaged arm and we can walk you through that process and you can work with customer all the way through. So really, it gives you, if you're experienced, you can use the packaged. If you're inexperienced, you can use the referral arm and really get the best outcome for your client when it comes to solving these problems. So time flies, we've gone over the hour. So it brings us to the end of today's session. So Raf, thank you so much for your time and your expertise today. You've both been brilliant.
Thank you, Chris.
Thanks for having us.
Thank you.
And attendees, I hope you found that useful. And now that you can see the option that bridging can bring, either as a plan B or as we've touched on here, as a plan A in some scenarios for your clients. So if any of the topics today have given you the spark for bridging finance or any of our other specialist sectors, please contact our mortgage desk, 01827 337710. The number's in the chat on the screen as well, and we'll be more than happy to help. Keep an eye on your emails for details of our next Plan B session. For all that's left from me, thank you for joining us. Stay busy, stay safe, and I'll see you soon.
Thank you.
Thank you.